All right, so what is the inflation endgame? And what is it you should be doing right now to protect yourself against massive money printing and all the different things that are going on right now in the economy? So to help answer this question, I've got a friend and just an amazing expert, Russell Gray, here with me to help talk us through. How are you today, Russell?
Good, Bronson. How are you doing?
Awesome. I'm doing well. I'm doing well. Um, I'm on the mend, but
Yeah.
really excited to have you today. I know a lot of folks are very interested in how do they protect themselves against money printing and what are things people should be aware of today. So just maybe you can kind of take it from there and just talk maybe about why this is a big conversation that people are concerned about.
Well, yeah. I mean, I think it is. You can't really be an investor unless you're paying attention to the economic environment, the financial system that you're investing in, whether you're a Main Street investor investing in real estate, apartment buildings, single family homes, whatever, or if you're a Wall Street investor and you're investing in stocks, bonds, mutual funds, that type of thing. At the end of the day, these things are all affected and denominated by the dollar. The dollar is how most Americans denominate their wealth. So when we talk about inflation, when you hear the word inflation, a lot of times think inflation is just rising prices. And it's not really. Some of my remarks at the New Orleans Investment Conference, I tried to make that distinction and help people understand what are the kind of the components of cost that cause prices to go up. But at its core, the concept of inflation is the idea that the purchasing power of the currency, in this case, the dollar, is going down. Now, we like that because when you buy a 3-bedroom, 2-bath house and just wait 20 years, the falling purchasing power of a dollar will cause the dollar denominated price of that house to go up. So that's what we call equity happens, right? That's the name of our book, Equity Happens. And if you have secured that house with debt, then the amount of equity you have relative to the debt you have on the property goes down. The debt doesn't go down in dollar terms, but it goes down in percentage terms. So if I put 20% down, put $20,000 down on a $100,000 house, I've got a 20% equity position. I've got an 80% loan to value. If that house doubles in price, now I gave myself a number I can't do the math on, but if it doubles in price and you have a $200,000 house and you still only have $20,000 of your own equity in it, then that $100,000 that you made is you 5x'd your equity, but your debt remains at 80,000. So now you've got $120,000 of equity against only $80,000 of debt. And that's why real estate is such a powerful vehicle, because it allows you to use debt to short the dollar. In other words, you get to spend tomorrow's dollars today and get an asset that then is going to respond to that inflation by going up in value. Real estate investors get this instinctively. Paper asset investors, people who don't understand how to use leverage prudently, don't get it. But that's something that everybody needs to be paying attention to, because inflation is not just hidden under the surface as it has been for the last several decades. It's now out in the open and everybody can see it. And there's not too many investors living today that really understand what's happening, why it's happening, and what they can do about it.
Yeah. Now, Russell, I've obviously you and Robert, you guys co-head the real estate guys, the events, the investment show that's been going for years and years. But one thing I admire about you is that you guys are real estate guys. But I know your own personal story is that you were just real estate guys, and then 2008 happened, and that kind of changed. So now you look at things in a much broader perspective. And you talk about what happened maybe in 2008. And just maybe some concerns for people that maybe only look at real estate and aren't looking at kind of the storm brewing beyond just what's happening, maybe in one particular sector.
Yeah, I saw my dad get wiped out in the stock market crash in 1987. And so I was working in Wall Street, or not in New York, but I was selling securities, mutual funds. And I decided that was snake oil. I knew that wasn't working. And so I graduated over into real estate, and I thought, oh, this is fantastic. This is Main Street. This is great. I understood inflation, the falling dollar, everything I just talked about, that I could use leverage, be great. In fact, I got so enamored of leverage, I started a mortgage company so I could really be in the business of leverage. And so we were out there using mortgages to control real estate all over this country. In fact, in 3 different countries, but mostly in the United States. And we were all like drinking our own Kool-Aid. We were all going to real estate events. Everybody was excited about real estate. Real estate was the most exciting investment going after the dot-com bust in the early 2000s, that big run up. And everybody was making gobs of equity and everybody was putting money into real estate. It just looked like the party was never going to end. Well, there were signs in the financial system that the party was going to end, but I didn't know how to read those tea leaves, so I wasn't paying any attention. I had my whole portfolio, my whole life, my whole business was geared on sunshine, on everything going well. I brokered debt. So I made money by brokering loans. I owned real estate, which was controlled by debt. And I didn't have any operating capital. Every bit of cash I had was used for down payments to buy more property. And I had these big credit lines. I had one of those American Express cards you can just run up as much as you want. And I paid it off every month. And then all of a sudden they started shutting my credit lines off. And then one day we took all the loans that we had to market and nobody wanted to buy them. The secondary market for mortgages went away. So now I couldn't earn any money, any cash. I didn't have any cash. Because the air had come out of the real estate equity jump house, all the equity went away. So now I'm upside down on these properties. And I was very thinly cash flowing, if at all, but I didn't care because I was making so much cash flow in my mortgage business. And so it was all good when the sun was shining, but I had no defense. I had no plan for what would happen if the credit markets collapsed, because that type of collapse was inconceivable to me. And I barely understood the credit markets. I just knew there was a lot of money out there. When those things all shut down, everything fell apart. I lost pretty much everything except the stuff that was offshore. And then the lesson coming out of that was I better start paying attention to the financial system, because it wasn't real estate that went bad. Everybody says, oh, real estate crashed. No, the credit markets crashed. The bond market crashed, specifically because of mortgage-backed securities. And mortgage-backed securities crashed specifically because a small percentage of subprime borrowers defaulted. You think, well, how could that little contingent of the market have such impact? It was because the financial system had levered it up with derivatives. And back then, people didn't really understand the concept of these derivatives. Today, people understand the concept. We have more of them today than we did back then. The system's more vulnerable today than it was back then, but at least now people are aware of it. And so that really converted me from being a pure real estate investor that lived in an echo chamber and only talked to other real estate investors to being a real asset investor and really wanting to understand the financial system and how do you own things that are real and essential that will weather the storm, whether it's a slow forming storm, just a continual erosion, the cancer that is eating the purchasing power of the dollar, or it's a complete systemic collapse or a great reset, which there's been a lot of talk of lately. However it plays, you want to be positioned because you can't predict the future. You don't know what's going to happen. You certainly can't control it. All you can do is be well positioned to pivot depending on what happens, and then be paying enough attention that you can see it happening in time to make your moves. And that's what we work on doing today.
Yeah, I think it's interesting. There's, as I've approached what you guys focus on, you look at things beyond real estate, you're looking at macroeconomics, you're looking at crypto, you're looking at farmland overseas, you're looking at all sorts of different trends in different types of things, gold and silver. And it's interesting too how someone that is very wealthy that doesn't want to lose their wealth may approach it very differently than maybe somebody who doesn't have any money who's trying to gain wealth. And I think but I think having approaches for everybody to be able to engage kind of where they're at and being aware of what is happening is so important. What are some ways that you think the average lay investor can just help, they can educate themselves more on what's happening right now and some steps that they should be taking?
Well, I think that it really starts with education. And it's funny, I'm sitting here in my studio and you can't see it on the camera, but I have a game called Mousetrap. And I don't know if you're old enough to remember that game.
Yeah.
But when I was a little boy, we didn't have video games. And so we had to play real games. And Mousetrap was a game that you put together. And it was this, mechanical structure And you would put a little ball in motion and it would work its way through a series of cause and effect. And then at the end, the trap would fall down on the unsuspecting mouse. I don't even remember how you won the game. I just thought it was fascinating how event A triggered event B, it triggered event C, triggered event D, all the way through this mechanism. And the financial system is a lot like that. And that's why everybody pivots off the Fed, because when the Fed makes a move, the impact ripples through the financial system. And if you don't understand the mechanics of the financial system, you don't really understand what it means. Like right now, as we're recording in October of 2021, the Fed is talking tapering again. I don't think the Fed can taper. I don't think it's a serious discussion. I don't think they can raise interest rates. So you have to understand those basic things. I won't get into the weeds of it, but the short of it is if interest rates go up, meaning the bid on bonds goes down. So if the Fed is not in the market bidding on bonds, bidding the price up like apartment buildings, they're not pushing the interest rates or cap rates down. That's the way the bond market works. For real estate investors who understand cap rates, they understand a low cap rate means a high price, right? So the more people bid up the same stream of income from an apartment building, the lower the cap rate. Interest rates are the same way. The more investors bid up a bond relative to its coupon, how much interest rate it's throwing off or interest income it's throwing off, the more the interest rate, the actual yield on the investment goes down. Okay. So that means that when interest rates go up, all of the bonds that exist that were originated prior to that interest rate increase go down in value. And if you understand that all these things have been leveraged in the financial system so that those trigger margin calls, equity is eroded, margin calls are issued, and there becomes a cash crunch. That's what happened in 2008. Then you don't understand how frail the financial system is. And so the financial system could and probably will completely shut down again at some point. And the question is can it be rebuilt as it was this last time, or is it going to be so bad that they actually have to erect a brand new system? And so the first thing to do is just understand that basic concept of how the markets work or how the financial system works. And then you have to pay attention to the inputs at the beginning so that you can see how it might impact all the way down to Main Street where you're at. Okay. That's number one. Number two is you need to then position your portfolio so that it doesn't matter if interest rates go up or down. It doesn't matter if the financial system collapses or doesn't collapse. You're not betting on the equity in your property being there, because the minute the financial system collapses, all the air comes out of the jump house, the credit markets collapse, that equity will disappear just like it did in 2008. Now, it may come back again if they can reflate it. But if you've taken the equity out as much of it as you can, well, you have, it doesn't matter to you because you've taken it if you've turned it into something real. Now, I'm a big fan of taking it out and turning it into gold, and I have a strategy for how you do that. You could turn it into silver. You could turn it into down payments on other properties, or you could turn it into paid for property in safer jurisdictions. You mentioned offshore farmland, oil wells. I mean, the idea is to own things that are real and essential. And if you think about it, energy is the economy. People have been eating food since the dawn of time and probably will be for quite a while, right? Housing is pretty essential. And there are other types of investments that are essential. Precious metals are hard assets or a form of money that has no counterparty risk, that doesn't require anybody issuing it. There's usually always a bid in whatever the currency is on those assets, diamonds. So there are things that you can buy that are real. And even if political systems fall apart, financial systems fall apart, currencies collapse, those things retain value. And if you have them apart from anybody having a claim on it, like when you remove your equity from a property in the good times and put it into things that are real, so that when the downtime comes, the property and the foreclosure is separate from the equity. You've moved it out of the property. That can be a defensive strategy. Of course, you have to deal with cash flow when you're borrowing equity out of properties, which is why I like a technique called arbitrage. If I can borrow it, say 3%, which you can do right now, and I can invest at 9% and get a predictive yield based on a good quality collateral, which you can do right now, then you could take $300,000 out of a property and you could put at 3%. And you could put $100,000 to work in an income producing investment at 9%. And you've made enough money on your $100,000 to pay for the $300,000. In other words, you're even, and you have $200,000 now of loan proceeds, not realized gains, no tax, that is completely free of any payment. Now I can invest in things that don't cash flow, like gold, like diamonds, like Bitcoin. And I moved my equity effectively out of the real estate into something more real.
Yeah.
Now, if they keep diluting the dollar and everything goes up in dollar terms, no problem, because then I can sell now my appreciated Bitcoin, my appreciated gold, my appreciated diamonds. I can sell a portion of them for the higher dollars and use that to retire the debt, because when inflation makes everything go up in dollar terms, it doesn't make the debt go up. Like we talked about earlier, right? If I have a $80,000 loan on a $100,000 house and the price goes up to $200,000, it's all equity. The debt doesn't go up, right? And so now if you bought two houses right next to each other, you could use the appreciation on property B to pay off completely property A. But you don't have to use real estate only. You can use other assets to do it. So that's the idea of opening yourself up as a real estate investor to look beyond the real estate as ways to gain safety and hedge against a falling dollar without necessarily having to take your foot off the gas. I mean, if you cash out of all your assets at cash flow, well, you don't want to do that. If you don't have any debt on your balance sheet, you don't really gain anything. If everything goes up in price, you don't really gain anything. The only way to gain is if you have debt and everything goes up in price. Right now you've gained because you can retire the debt with the new equity and then own whatever the assets are free and clear. And that's how you weather a storm. If I would have known that in 2008, it would have been a lot less painful for me, but I was only playing offense. I wasn't playing any defense whatsoever. It was, one of the best lessons I ever got, but also one of the most expensive.
Yeah, no, it is. It's important to really think about what is happening, how times are changing. You mentioned this kind of when you were talking about the idea of buying things that are real. I know a lot of investors, a lot of individuals, myself included, it's been challenging to think outside of the dollar, right? We always think, oh, I'm going to make this amount and this many dollars and this kind of, but this comes from really a low inflationary environment that a lot of us really have grown up in, and not the high inflation era of the 70s and early 80s. And so if inflation picks up, I want you to talk a bit about this. People wonder, and why are you into precious metals, gold and silver, and these kind of things? It doesn't seem, especially my real estate friends, a lot of them don't really get that conversation. But can you talk a little bit more about metals, about why, or maybe why it's important to think outside of the dollar, and maybe a little bit more about your precious equity strategy that you mentioned. I've heard you talk about it several times, and just why it's important to think in those terms.
Well, for almost all of human history, civilized human history, gold has been money. The only time that it hasn't been is the last 50 years, right? We came off the gold standard on August 15th, 1971, when Richard Nixon defaulted on the convertibility of dollars into gold. Gold is money, the first layer of money. And a dollar used to be a derivative of that money. In other words, it was a claim on the money. You could take the dollar and redeem it for gold. It wasn't money. It was a coupon or a certificate representing money. Over time, many of the people living today have forgotten that. And so they think that a Federal Reserve note, and anybody that knows basic contracts and money, finance, knows that a note is an IOU. You're holding a Federal Reserve IOU, but what do they owe you? They used to owe you gold. They used to owe you silver. Today, they don't owe you anything. So it's a note. It's just an IOU, but you can't redeem it. There's no way to get rid of the debt. So the idea is that in the financial system, central banks, and if you think about it, you've heard of insider trading, right? So insider trading is when people who are in the know are buying the thing that everybody else doesn't know about or isn't paying any attention to. And when it comes to insiders and it comes to currencies, there's no greater insider than the central banks, because they issue the currency. They know more about currency than anybody else. That's what they do. They're the ultimate insider. And what are central banks buying? Gold. They're buying gold. And so if you're busy thinking that, you're collecting the paper that they print out of nothing, and they're busy collecting the gold, which they can't print out of nothing, then all of a sudden you realize you might be on the wrong end of that deal. And so gold has had thousands of years of history of being money, and it's still today in today's financial system is a very important financial asset on the balance sheets of banks. So if you don't have any on your balance sheet, then all you're holding is derivatives of something else that's real, but no ability to redeem it unless you can find a way to do it, as we've said, creatively. Now, up until from 1933 till 1974, even though the dollar was backed by gold, Americans were prohibited from owning gold. That changed in 1974. As soon as Americans were allowed to own gold, in fact, from the time the peg was broken in 1971, gold went from $35 an ounce all the way up to, what is it today, $1,800 an ounce? Okay, well, gold didn't change. An ounce of gold is an ounce of gold. It just meant that there was $1,800 a claim against that 1 ounce of gold versus 35. And that just shows the dilution of the purchasing power of the dollar. So people who bought gold and put it in their savings instead of $35 and put it in their savings today have $1,800 worth of gold versus they would only have $35 of purchasing power if they had just kept the dollars. And so that's why people own precious metals. The other thing is, if the dollar completely failed, and I'm not saying that's going to happen, but if it did, then you could sell your gold for euros, for Canadian dollars, for Aussie dollars, for Chinese yuan, for Japanese yen, right? It's home base. So when I was a kid, I used to play tag, and if you could get to home base, you were safe. You'd have a place you could pivot off of to run to the next area, and if you're doing those tag games where you had different bases and you could progress across a field of play, and you could get from base to base to base to base, right? If you're out in this field of play in currencies and you are sitting in home base of gold, then it doesn't matter what happens to any particular currency, because as long as there's one that's good, you can pivot into it, right? And Americans have really, for the most part, never been able to think outside the dollar. We've been the world's reserve currency since Bretton Woods in 1944 or 45. And so every other country in the world has to think both in terms of dollars as the world's reserve currency and their native currency. Americans only think in terms of dollars. It's harder for Americans more than any other people in the world to understand how to think outside the dollar. It used to be people thought in terms of dollars and they thought in terms of gold because they were synonymous, but they're no longer synonymous. And so you have to think in terms of gold, which is money, in terms of dollars, which is what you're denominating your currency in. And then you have to think about a future where the dollar may not be the currency. And then if it isn't, and that's all you have a plan for, that's all your savings is in, then you may end up on the wrong end of whatever conversion process moves you into whatever the new currency is, the great reset, whatever that is. Jim Rickards talks about it in his book, Death of Money and Currency Wars, talks about the SDR, special drawing rights. It's just a new form of artificial derivative. These are currencies that are derivatives of somebody's balance sheet. Dollars are a derivative of the Fed balance sheet. SDRs would be a derivative of the IMF balance sheet, right? Versus gold is not a derivative of anybody's balance sheet. It's money, according to J.P. Morgan, congressional testimony in 1912. Gold is money, nothing else.
Yeah, absolutely. Yeah, it's something I think, as I've gotten my head around the importance of owning physical precious metals, being able to have them for many reasons. One is obviously as an insurance that as more money is printed, you have something that hedges against that. Obviously, debt is a great hedge, and real estate, long-term real estate, particularly cash flowing or commercial real estate, our businesses, multifamily, is a great hedge against that. Can you touch base? I don't think you really covered this part, but the precious equity strategy where you buy gold and then you basically can borrow against the value of the gold. Is that the precious equity strategy again?
Well, it's bigger than that. The first step is to take equity that you've accumulated in a property and use that arbitrage I described earlier. I'll do very simple math. You have a couple $100,000 of equity in a property, you borrow it out at 4%, you got an $8,000 interest payment. I take $100,000 and invest it at 8%. And I have an $8,000 interest income. I'm break even on the cash flow, but I have $100,000 free and clear with no tax, no payment. So let's say I take $50,000 of that and I put it in a qualified retirement plan. And maybe I take the tax deduction, putting it in, which gives me an immediate tax break, or maybe I do it in a Roth and I don't. But at the end of the day, I put it into a very tight asset protection structure. And then from there, I purchased gold. And now I'm holding gold in my physical possession, no counterparty risk. I don't need to worry about a bank holiday. I don't need to worry about default. I own the physical gold. It is inside my safe at my home or wherever I'm storing it. And it is inside held in title by my qualified retirement plan, which is basically judgment proof, foreclosure proof, IRS proof, very, very safe. Okay, so I've taken my home equity or my property equity that was out there subject to foreclosure, subject to lien, subject to the market evaporating it, and I've moved it into a much tighter asset protection model, and I've eliminated counterparty risk, and yet my equity on my balance sheet is the same. And in this case, I now have I had $200,000 on the property, in the property, but I still own the property. I pulled $200,000 out, but I put $100,000 into a note receivable, so that's an asset, and I put $50,000 into gold, so that's an asset, and I have $50,000 in cash, so that's an asset. So on my balance sheet is neutral. I just moved $200,000 of equity from my property to $200,000 into a note receivable for cash flow, a better cash flow than it cost me. I bought gold and I kept cash. Now I could use that cash. I could buy Bitcoin with the other 50,000. I could do that. I could put it inside. I could put it inside a Roth IRA and put the Bitcoin inside of that. And if Bitcoin went from 60,000 to 600,000, I got a 10x. I'm not saying that's going to happen, but if it did, now you're in a tax-free environment. So the point is your equity can do a whole lot more, and your equity is precious, but it's also fragile. So precious equity is the idea of getting the equity out of the property, using arbitrage to retrieve it, and then recharacterizing the equity on your balance sheet into assets that are more resilient, that are more asset protected, that are protected from counterparty risk, and then can pivot outside of a currency. So, because if the credit markets collapse, equity comes out of real estate really, really fast. I mean, we know that that's the case. If interest rates go up, equity goes down, right? If credit markets, lock up and there's no lending, equity goes way down. The property doesn't go away. The tenants don't go away. It's still a great asset. When the credit market comes out, the equity goes away. But if you can recharacterize it when the sun is shining into things that are more enduring, then you have a better prepared balance sheet. You haven't changed your net worth. You haven't changed your cash flow at all. You've just recharacterized. So that's what precious equity is about. Real estate makes sense because you're owning something that's real. You're serving a basic human need, housing. Rents tend not to fall as fast or as far as equity does. We know that from 2008. So the key is just being able to control that debt. And in fact, going back to the arbitrage strategy, if I've got accessible equity in a property, I can enhance my cash flow in my portfolio by arbitraging it. Right? If I borrow money out of the property at 3 and I invest it at 9, then I have the same amount of equity, but I'm getting +6 on the cash flow. I've improved my cash flow on my property. So I'm just not a fan. I'm a fan of equity. I'm, real estate to create equity. I'm just not a fan of real estate as a place to store equity unless you're 100% paid off. No debt whatsoever, because at least then you don't have that foreclosure risk hanging over your head. But then you have lawsuit risk, lien risk, and if you lose it, even if you can't afford to pay the taxes and they seize the property. I mean, if you got a pile of equity sitting there, you can imagine if you have all your equity in your safe and gold in your qualified retirement account, and you lose control of the cash flow on the property, you end up in a lawsuit. You end up in any type of a situation where you can't pay the property taxes. They can go ahead and take the property and you'll lose it, but you're already taking the equity.
Right. Yeah, no, we've talked about that before in some videos we've done about, if you have a home paid off, you are a lawsuit risk, there's liability, you're not using your capital correctly. There's lots of different things with that. But I know we're kind of coming to the end of our time here, Russell, but I just wanted to say, I really appreciate you and your role as just being someone who educates people about real estate, as well as metals, as well as inflation, as well as a lot of these things. You just have a way of really painting a picture that's very easy to understand for a lot of people. So I wanted to thank you for that. I've gotten so much about from being a part of your events, especially your Investor Summit that I know will be in Belize this summer. I'm already signed up to go. I can't wait, and get to spend time with people like you and just George Gammon and all sorts of amazing guests that go on that trip. So really thank you for everything that you add to this conversation, to of course to our guests as well. But how can people get in touch with you, Russell?
I think the best way you can listen to us, the Real Estate Guys radio show, if you go to realestateguysradio.com, realestateguysradio.com, then you can hear about our events. You can find out about those. You can find out about our show, our YouTube channel, everything's there, realestateguysradio.com. Appreciate it, Bronson.
No problem. Thanks again for coming. Really appreciate it, Russell.
Thank you.
All right, so this was a great episode of Mailbox Money. Russell Gray is one of my favorites. He just has a way of breaking things down to a very, very simple level. If you don't invest in precious metals, I suggest that you look into that because, dollars are simply paper. There's really nothing that says they can't print more and more and more and more dollars. And it's a fact that somewhere around 40% of all of the US dollars in circulation now were printed in the last 18 months. And that can only continue. And so we have some just unfathomable numbers of just things being printed, and things are continually changing in the financial world. So if you know how to use it to your advantage, he talked about taking on debt at a very low rate. This is something I was able to do, get a very low rate on a personal line of credit and be able to go use that to invest in something at a much higher rate. I'm not giving you personal advice on what you should do, but just for educational purposes, for myself and for Russell, it has worked out fairly well to go after strategies such as that. So anyway, again, I recommend the Real Estate Guys events. They're great. They have a great event on syndication if you're interested on learning how to syndicate, which just means how to put together large real estate deals where you raise money from other folks. That's something that I've been able to do, and now been able to raise over $20 million to do large multifamily deals. And so if you're interested in joining us on a multifamily deal, you can go to bronsonequity.com and you can click the join button, and you can set up a call. We can start a relationship with you and let you know about our upcoming deals. So thanks for taking the time to educate yourself. We'll look forward to seeing you on the next episode.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.